Welcome, and thank you for joining us for another episode of KPMG's Inside International Tax, a podcast devoted to recent developments, observations, and trends related to U.S. international tax. I'm one of your hosts, Kristen Gamboa, a managing director in KPMG's WNT International Tax Practice. I'm joined by my co host, Gary Scanlon, a principal in the same group. Hey, Gary.
Hey, Kristen.
So on September 12, 2024, Treasury and the IRS released the much anticipated proposed CAMT regulations, the first piece of regulatory guidance on the corporate alternative minimum tax, or what we call CAMT. Weighing in at just over 600 pages, the proposed regs cover a variety of issues, but our discussion today will focus primarily on its international tax provisions, including the rules pertaining to foreign parented multinational groups, CFCs, effectively connected income, and CAMT foreign tax credits. For our discussion today, we're joined by Dan Winnick, a principal in KPMG's WNT International Tax Practice, and Sivan Dunksar, a senior manager in the same group. Welcome to the podcast.
Thanks for having us.
Happy to be back, Kristen.
So to refresh everyone on the CAMT basics before we dive into the contents of the proposed regs, CAMT applies to corporations that have over $1 billion of annual average adjusted financial statement income, or what we like to call AFSI, measured over any 3-year period starting in a tax year ending after 2019. Aggregation rules apply so that for purposes of this $1 billion test, a taxpayer includes the AFSI of all members of its Section 52 group. Also, special rules apply for foreign parented multinational groups, or FPMGs, which we'll discuss in more detail shortly. So just because a corporation is in scope for CAMT doesn't necessarily mean it has a CAMT liability. The taxpayer only has a CAMT liability to the extent its tentative minimum tax, which is 15% of AFSI minus its CAMT FDC, is greater than the taxpayer's regular tax liability, less its regular tax FTC, plus its BEAT. For some taxpayers, a CAMT liability will only be a temporary cost because a CAMT liability generates a CAMT credit, which can potentially be used to offset future regular tax. For others, a CAMT liability is a permanent expense, either because they're chronically CAMT or their general business credits effectively crowd out their CAMT credit. Before we dive into the substance of the rules, let's talk a little bit about when these rules are proposed to be effective. Sivan, when do taxpayers need to care about these rules?
As is perhaps not surprising, considering the size and breadth of this package, different applicability dates are proposed for different sections. So certain provisions, such as those dealing with general M&A, partnership, Section 168 property, as an example, those are proposed to apply prospectively only. So only to tax years that end after the final regulations are going to be issued. And then by contrast, the international rules that we've been focusing our attention on and are part of what the proposed regulations refer to as specified regulations, those are proposed to apply for tax years ending after 9/13/24, the date the proposed regs were published in the Federal Register. And the specified regulations really cover the nuts and bolts of the scope determination. They include, importantly, the simplified safe harbor, certain AFSI adjustments, like as we said, for taxes and CFCs, M&A involving foreign corporations, the CAMT FTC, and the new anti-abuse rules. So while none of the proposed regulations would apply for calendar year 2023 taxpayers, a taxpayer with a fiscal year ending after 9/13/24 could be forced to apply these rules to a year beginning in 2023, assuming the government retains these effective dates in the final regulations. And they have requested comments on the applicability dates, so we shall see.
So most of the regs, when finalized, will be applicable to tax years ending after September 13th, 2024. Can taxpayers early adopt a rule in the proposed regs? As we'll discuss later, Sivan, there are some taxpayer-favorable rules here.
So taxpayers are free to early adopt for 2023. With that said, if a taxpayer early adopts any section of the proposed regulations, that taxpayer and each member of its Section 52 group or FPMG also has to early adopt not only that rule or that section of the proposed regs, but also all of the specified regs in their entirety also. And then they have to continue to do so for each subsequent year until the final regulations are published. So this means that early adoption comes with a commitment to follow all the specified regulations, not just the favorable rules, and it also binds the whole group.
So, assuming that you don't early adopt, as you know, the IRS issued several notices in the lead up to these proposed regs. Can taxpayers continue to rely on these notices?
Yes, thankfully, calendar year taxpayers can still rely on the notices and can generally still pick and choose their own adventure for the most part. Taxpayers are also always free to rely on the statute. With that said, taxpayers can no longer rely on the notices for tax years ending after the proposed regulations were filed. So that means those tax year ends after 9/13/24 won't be able to rely on the notices even for their first CAMT year. So this puts tremendous pressure on taxpayers that are relying on the safe harbor, for example, because there is no safe harbor under this statute. So some taxpayers may need to early adopt the proposed regulations just to be able to access the simplified safe harbor.
Yeah, that's a really good point. Now let's talk about the substance of these rules, the international tax sections of the proposed regs, focusing on the outbound issues first, beginning with the CAMT-FTC. If a taxpayer elects to credit taxes for regular tax purposes, the statute provides a CAMT-FTC for certain direct taxes and CFC taxes that are paid or accrued in the year and taken into account on the taxpayer's applicable financial statement, or AFS. The 2023-64 notice seemingly minimized the importance of the taken into account requirement. Do the proposed regs adopt a similar approach, Savan?
They really do, and then some. The proposed regulations lean even harder toward regular tax, not just for timing, but for the amount of the CAMT FTC. In the partnership context, perhaps following the suggestion in our comment letter, the proposed regulations would treat a partner's share of creditable foreign tax expenditures for regular tax as the amount that's creditable for CAMT, which, if you've glanced at all at the other proposed partnership rules, you'll be very thankful for the simplicity in this approach.
Yeah, I think taxpayers will appreciate the regular tax approach to these regs in many regards, but are there any drawbacks to this approach?
Yeah, unfortunately. So while still no 904 limitations based on source and basket, the proposed regs would generally import any suspensions or limitations for foreign tax credits that exist in the code, including 901M, 909, 907, 901J. Really, it appears to be every limitation in the code.
Thanks, Savan. So the statute has an add back for taxes in 56 Cap A C5 to effectively disregard the impact on financial statement income from federal and foreign taxes. This is also called the tax add back, but it's effectively trying to get taxpayers to a pre tax amount. There is authority in that statute for Treasury to write rules that limits this add back for taxpayers that do not choose to credit their taxes. Does the government take up this authority in the proposed regs?
Yes, Gary, they helpfully do take up that authority, and the proposed regulations would permit an applicable corporation that deducts foreign taxes to reduce its AFC by its Section 164 deduction for regular tax purposes.
Savan, you said that this rule is only for applicable corporations. Does that mean this rule doesn't apply for scope purposes?
That's right. By limiting the reduction for foreign taxes that are deducted to applicable corporations, it does not appear that the reduction can be applied in determining scope. But I would say this seems to put deductors on par with those that credit because Creditors are also similarly not permitted to reduce their scope AFC by foreign taxes. And this is because the CAMT-FDC only applies for liability as well.
Thanks, Yvonne. So, shifting gears a bit, let's talk about CFC issues. So, under the statute, taxpayers are required to make certain adjustments to their FSI to arrive at AFC. A U.S. shareholder, for example, is required to include in AFC its pro rata share of its CFC's aggregate adjusted net income or loss, or ANI. But if the CFCs are in an overall loss position, the adjustment for the year is zero and the negative adjustment is carried forward. Sivan, do the proposed regs provide any additional guidance on how to compute a CFC's ANI or the U.S. shareholders' resulting increase in its AFC or CFC adjustment?
They do. The proposed rules would clarify that all the AFC adjustments in 56 Cap A are applied at the CFC level in determining its ANI, which is something that was sort of expected given the approach to the Form 5471 H1 worksheet that we saw this compliance season, because it makes you go through all the AFC adjustments for CFCs. The regs would also clarify that a negative adjustment can only originate in post 2019 years and is carried forward and absorbed in each year on a FIFO basis, even if the taxpayer is not an applicable corporation in that year. And then for liability determination, mirroring the reduction to AFC when a taxpayer deducts rather than credits foreign taxes, the proposed regulations would also reduce the aggregate CFC adjustment of a U.S. shareholder. But to determine the amount of the reduction, the taxpayer has to compute a hypothetical CAMT CFC FTC, and then also would apply any limitations to the extent the taxes would be disallowed or suspended for regular tax.
That's really interesting. So, what about another issue that's so near and dear to our hearts that we at KPMG wrote a comment letter on it, CFC dividends? Our listeners may recall that double counting can occur under the statute because a taxpayer is required to include dividends and other tax amounts that it receives with respect to corporations that are not part of the taxpayer's U.S. tax consolidated group, which includes CFCs, notwithstanding that the taxpayer has to pick up its CFC ANI as well. Notice 2024-10 provided limited relief for CFC dividends. Do the proposed regs extend the relief provided by the notice?
Yes, the proposed regulations generally adopt a broad regular tax replacement approach for items resulting from ownership of foreign corporation stock, and that's including CFCs. For example, to the extent a dividend from a foreign corporation, including a 1050 company, would be afforded a Section 245 Cap A DRD for regular tax, that dividend is similarly excluded from AFC. Notice 2024-10, as you mentioned, applied, but only for actual dividends. And the proposed regs would extend this also to deemed dividends under sections 304, 367B, 1248. And then importantly, though, they also clarify that section 78, 250, 951, 951 Cap A amounts, those are not included.
So that seems to be a really helpful simplification for taxpayers. Is it just about dividends?
No, it actually really is beyond dividends. This broad regular tax replacement rule generally applies for all items relating to stock ownership of foreign corporations, including CFCs.
Do the regs create any traps for the unwary in this area?
Yes, they do. There's an anti abuse rule aimed at basis disparities that are caused by this shift to regular tax, and they apply for certain covered asset acquisitions. And it would make you include in AFC the difference between your CAMT basis and your regular tax basis in an asset if you try to use that basis within 2 years.
Thanks, Yvonne. So now let's shift to a discussion of inbound issues, starting with the Foreign Parented Multinational Group, or FPMG rules. Before we dive in, Dan, could you provide those of our listeners who are unfamiliar with the FPMG rules some background?
Thanks, Kristen. Taking a step back, for corporations that are not members of a foreign parented multinational group, they're in scope for CAMT if they have more than $1 billion in AFC in any 3-year testing periods. For corporations that are members of a foreign parented multinational group, Whether they're in scope for CAMT is determined based on two tests. The $1 billion test is modified to include global income of the FPMG, and there's an additional $100 million test that only looks to the US related AFC of the Section 52 group. So, as an initial matter, a taxpayer has to determine whether they're a member of a foreign parented multinational group in order to know which set of rules apply. Under the statute, you have a foreign parented multinational group if you have two or more entities, one of which is a domestic corporation and another is a foreign corporation. They're included in the same AFS for the year, and they have a common foreign parent.
So clearly, the FPMG determination is important for determining whether a corporation is an applicable corporation and therefore subject to CAMT. The statute gives the Secretary broad authority to determine which entities should be included in an FPMG and potentially even deem there to be a common foreign corporate parent. Do the proposed regulations take up that authority?
That's right, Kristen. The proposed FPMG rules expand the definition of FPMG, both by expanding what entities are considered included in an AFS and what's the common foreign parent of the AFS. In particular, they expand the FPMG rules so that a partnership can be treated as the parent of a foreign parented multinational group, whether it's domestic or foreign.
So, what does it mean to be included in the same AFS? Does that mean consolidation or is there a certain percentage of ownership required?
So, in general, being included in the same AFS means that you have line by line consolidation between one corporation, the subsidiary, and its parent. In general, an FPMG common parent has a controlling interest in a corporation if the corporation is required to be line by line consolidated, but there are a host of deemed consolidation rules in the regs. An entity is treated as included in the same financial statement, even if it's excluded because the entity is immaterial in wind down or permitted but not required to be included. This rule is similar to the Pillar 2 rule that deems consolidation, where consolidated financial statements under the applicable financial accounting standard would be prepared on a line by line basis. But there are a few important differences that might distinguish the CAMT deemed consolidation rule from the Pillar 2 deemed consolidation rule. In particular, if an entity is permitted but not required to consolidate, under CAMT, it will be deemed consolidated. That's not necessarily the case for Pillar 2. The CAMT rules also default to using US GAAP consolidation principles where there is no applicable financial statement under a relevant accounting standard. So, to the extent there's a difference between US GAAP and another financial accounting standard, you might have a different answer for CAMT than you would have for Pillar 2. The CAMT rules also have special rules for foreign corporations with a U.S. trade or business. So, under the statute, a U.S. trade or business is treated as a separate domestic corporation solely for purposes of the FPMG rules. The proposed regulations make clear that regardless of how a U.S. trade or business is accounted for, the foreign corporation will be treated as having a controlling interest in the deemed domestic corporation, its U.S. trade or business, and so they'll be treated as effectively a foreign parented multinational group unless that foreign corporation is actually domestically controlled. The most significant expansion included in the same applicable financial statement that the controlling interest standard provides is that if an FPMG exists, based on the rules we've already discussed, any subsidiary that's in the Section 52 single employer group is treated as a member of the FPMG. This is true even if the subsidiary is accounted for as an investment rather than on a line by line basis.
So, this is a significantly broader definition than under the statute, which means that potentially more taxpayers are going to find themselves in an FPMG. Are there any other consequences of being in an FPMG group beyond having to apply the two AFC tests?
Yes, so under the statute, the FPMG definition only applies for purposes of scoping, for purposes of determining whether or not you're subject to CAMT. Once you're past the applicable corporation test, whether you're in an FPMG under the statute shouldn't be too important. However, under the proposed regulations and under the notices that preceded the proposed regulations, A member of an FPMG is required to use the foreign parent's consolidated AFS for all AFC purposes, even if it has what would be a higher priority financial statement under the rules that are applicable for corporations that are not members of a foreign parented multinational group. For example, if the US operation has US GAAP financials, the foreign parent's financials that might be prepared under IFRS would still be the applicable financial statement. This is true even if the US subsidiary is an SEC registrant, for example, that files a 10K, which would ordinarily be the applicable financial statement. This is especially important because for purposes of determining CAMT liability, a U.S. corporation that is subject to CAMT and is a member of a foreign parented multinational group would have to use those foreign parented financial statements, even if it would have a higher priority U.S. GAAP statement.
Thanks, Dan. So the statute says that to determine the AFC of a foreign corporations, the principles of Section 882 apply. Section 882, in turn, provides that a foreign corporation engaged in a U.S. trade or business is taxable on its effectively connected income, or ECI. Do the proposed regs provide guidance on how to determine what part of a foreign corporation's financial statement income is ECI for purposes of CAMT?
So, Section 56AC4 left a lot to be desired in terms of guidance on what is effectively connected income, or ECI, for CAMT purposes. The proposed regulations provide some additional context, but stop short of providing rules for calculating ECI for these purposes. Although the proposed regulations don't offer much clarity on the ECI rule, they do explain that a foreign corporation's ECI is adjusted to include only amounts that would be included in ECI or allowable as a deduction under Section 882C. The lack of a prescribed method for determining a foreign corporation's adjustment to AFC for ECI purposes, in line with Section 882 principles, leaves taxpayers with some flexibility. This means that they may have some leeway in figuring out what portion of their income is attributable to ECI and included in AFC, and may be able to determine what income is includable in AFC as effectively connected income based on existing processes and procedures they had in place for regular tax purposes.
Thanks, Dan. So notice 2023-64 exempted treaty protected ECI from the definition of AFC. So this applied for both the $100 million FPMG US AFC test and for the liability computation. Do the proposed regs retain this approach?
So, one surprise in the proposed regs was that they did not contain any rule with respect to treaty benefits and did not explicitly incorporate Notice 2023-64's rule that would treat treaty protected ECI similarly to income that wasn't ECI. The preamble does note that Section 894A provides that the code is applied with due regard to treaty obligations of a taxpayer, and this suggests that taxpayers should be able to exclude treaty-protected income from AFC. But that said, existing income tax treaties generally don't address the implications of effectively connected income beyond the imposition of a tax liability. So while Section 894A provides some guidance, it provides less comfort than the notice did for scope purposes, specifically whether or not treaty protected ECI is excluded from AFC for determining whether or not a corporation is an applicable corporation. The lack of guidance on treaty protected ECI also raises a question under the foreign parented multinational group rules we were discussing earlier. It's not entirely clear whether effectively connected income that is not subject to tax under 882 because of a tax treaty gives rise to a foreign parented multinational group under the deemed domestic corporation rule.
Let's move on past the ECI issue, though it's interesting. Dan, the proposed regs contain a general anti-abuse rule. Can you tell us about this rule and what you think the import of it is?
That's right, Gary. The proposed regulations provide a rule that targets arrangements to avoid the application of CAMT or otherwise improperly reduce CAMT liability. The preamble suggests that an improper arrangement for this purpose would include, for example, filing a financial statement with the SEC or a foreign agency equivalent if such a filing is not required but is made for the purpose of affecting the applicable financial accounting standard under the proposed FPMG rules. This rule needs to be considered whenever CAMT is the principal motivation behind the creation of an AFS. More generally, the general anti-abuse rule in the proposed regulations raises questions whenever a taxpayer might be changing its financial accounting standards or practices with a view toward affecting their CAMT liability or AFC computation.
So the proposed regs also include a couple related party rules. Dan, could you tell us about those?
So the proposed regulations also include a clear reflection of income rule and a loss deferral rule. The clear reflection of income rule would require adjustments to AFC in situations where any item of income, expense, gain, or loss reflected in FSI related to a controlled transaction or controlled transfer between two or more CAMT entities does not reflect the principles of Section 482. The loss deferral rule would defer losses arising from transactions between related CAMT entities until the underlying property that gave rise to the loss is no longer held by a related party of the CAMT entities.
So, as we wrap up this episode, any final thoughts?
Yeah, I think one thing, this, as we've been talking about, this is a big package. There's a lot in it. There are also a lot of requests for comments. And one thing to remember is comments on these proposed regulations are due by our math on 12/12/24. So 90 days after the regs were published in the Federal Register. And then another opportunity for taxpayers to be heard. There's going to be a public hearing on the proposed regulations, which is scheduled for 1/16/25. So again, I think if we think of these proposed regulations in many cases as the government's first bidding, taxpayers should be mindful of these deadlines.
Thanks, Sivan, and thanks, Dan, for introducing us to the CAMT proposed regs, and a special thanks to Matt O'Neill for his help behind the scenes with this episode. While the proposed regs provide us much needed guidance, they also leave us with some unanswered questions. We're all still digesting these rules almost a month later and trying to figure out their practical impact. And we still have final regs to look forward to. So, as always, please stay tuned for future episodes of KPMG's Inside International Tax to stay up to speed on the latest developments in U.S. international tax. Till our next episode, take care.